Okay, now we're going to look at how to use relative strength charts in relation to Forex. So we actually did look at this a little bit with currencies before, but we were using exchange traded funds then. But this time I'm going to actually use the spot Forex markets. And so here's some pairs. These are the four that I pretty much focus on, but here's some lighter traded volume pairs as well. Now I've already put four of them on here. Okay, so there's the Euro US dollar and US dollar Swiss franc. Okay, dollar yen and pound dollar. So again, just to show you how you do this on TradeStation, you have to go to insert symbol each time. Alrighty, then this little dialog box will pop up. Then we just type it in, GBP, CHF, and there's another line. Okay. We'll put a few in. I'm not, normally you would go ahead and put them all in if you wanted to, or just put in the ones you want to trade. Really, you just want to put in the ones you want to trade. Now, if you trade all of them, then you put all of them in, but it can get a little crazy. Another thing you can do is you can create two of these charts. If you get too many markets that you're looking at, and you want to, really compare a lot of different markets, then just go ahead. We're going to change the color of this because it gave us two cyan colored ones. Oh, what color don't we have? Oh, we don't have a dark gray one. Okay, it's different enough, I guess. Alright, so we'll leave it at that now anyway. We don't want to spend a lot of time on the video just plotting price lines. But again, and this applies for Forex or anything else, if you're watching so many markets that it starts to get a little crowded on your chart, just create a bunch of these charts. That's what I do, because I've got a bunch of these. I've probably got about 7 or 8 of them. And I've got, really what I plot is the watch list of exchange traded funds. So that watch list that you have, if you want to know exactly which ones I put up there, that's what I put up there. So all the countries, actually there's more countries than fit comfortably on one chart, so I think I've got like 3 different charts of the countries, a couple of the currencies, about 3 or 4 of different industries, and things like that. Okay, kind of spreads it out a little bit. So that's pretty much it. Now, again, remember that you do want to be careful. Some of these later traded markets can be a little more difficult to trade as far as getting slippage and so forth. So I recommend you don't go with really late traded markets for anything. I don't trade penny stocks, for example. I don't trade lightly traded futures markets. And so that's why for me, mostly I'm sticking with, the most heavily traded Forex markets as well. But that's up to you. It's your personal decision. Put whatever ones you want to trade up here. The rest, you don't need them because you're only looking at the ones that you want to trade, which have the highest relative strength among the tradables that you will possibly be actually committing money to. So it's really exactly the same as before, but I know people like to see examples of this stuff. So remember, it's a percent change chart, and again, just a quick little review on that. Here's your percent change chart thing where you go ahead and click this and you click enable. Now you can do this to calculate from first bar, last bar, or this bar. I don't think I actually demonstrated that before. First bar is what I do. Okay, so just to be clear on that last bar, yeah, it's just that's not what we want to do. And from this bar, you can choose a bar. But what I do is just to make it real easy, I enable percent change chart, calculate from first bar, and then we go 3 months back. So it is starting, and so if you go 3 months back, what that means is it's going to start at 0%. Okay, so they all start here at 0% 3 months ago. And then what's the percent change since 3 months ago? Now again, you may say, well, I don't want to do 3 months ago. I want to see what the percentage change is in the last 30 days or the last year. And, you know, that's certainly fine. There's no magic to 3 months ago. So depending on your trading horizon, how long you're going to hold these trades and so forth, play around with it a little bit. You know, this is what I use. If you want to know, most people want to know, well, what do you use, Barry? Well, this is what I use. And why is also a good question. And for me, 90 days back is, see, as I said, when I'm using these kind of charts, I'm really looking for markets that have been underperforming and are maybe starting to turn around. So I don't really want to go just a month or two back. That could be a very short-term underperformance. So 3 months is the minimum time I want to go back. You could even go back further. You know, you could go back a year or 2 years to find those have been underperforming for a long, long time. But I don't do that just because some of them that have been underperforming for that long, the little pops they get sometimes don't mean that much. So anyway, it's all just a matter of probabilities. It's like everything else, you know, everyone's looking for certainty. You know, give me the exact number, how far to go back, which market to trade, what point to get in, all this stuff. And the market's never going to give you certainty. So you really need to examine your own mind when you ask these questions and say, what am I really looking for? And most of the time what you're looking for is certainty. And it's good to acknowledge that too. First of all, be aware of that. And then number two, acknowledge it. And then number three, say, okay, I have to be aware the market will never give me certainty. It's only a matter of probabilities. And therefore I need to be asking maybe some different questions, because the line of questioning that I'm going on here is not going to lead me to anything profitable. And worse than that, it's actually creating a mindset that is putting me along with the group of retailers, the group of losers. This mindset is defeating me. Okay, so anyway, a little sidetracked there, but very, very important stuff. I always like to put some of that stuff in all my videos anyway. So what we're going to do then is I like to look at some of these that have been most underperforming. So what do we got there? Okay, British pound, yen. And again, some of this will be review, but where's my lines? There we go. Gotta adjust my charts. Okay. So first thing I'm looking for, I'm going to take it off of snap mode. In fact, let's make sure it's totally off snap mode. Okay. So the first thing I'm going to look for is it breaking a high? Well, there's two things. That's not actually the first thing that I look for. That's the second thing. First thing is trend lines. So, trend line, a trend line break, like that, would be your first and earliest indication of a shift of energy. Now that, again, normal part of trading, the earlier indicators are usually the least reliable indicators. So yes, it gives you the earliest indication, but it's the least reliable. But I do both. So I'll put trend lines on and I'll watch that and I'll say, okay, here's my trend line break, right here. Muy interesante. And so that's kind of nice. But then the second thing that we look for is a break of a high. And the high we're looking at is that one right there, this high. And that happens right about here. So it breaks through there. Okay, so that's a little lagging, but more reliable indication that there may be a shift of energy. However, let's take a note of something else that goes on here. So what we had, and by the way, let me just demonstrate this for you. So for example, back here, what happened? There is a break of a trend line. There we go. Okay, break of a trend line there. But did this market really reverse? The answer is no, because there's your high. It never broke that high, and then it made lower lows. Okay, let's look at another example. Let's take these off of here. Okay. Another example, just for clarity, is trying to find one that it's not so messy. We've got a lot of lines overlapping each other. Well, this orange one, same one, if you can see. Trend line there. That's not broken. Let me get trend line here, here, there we go. Okay, that trend line is broken, and we break these highs, but it's short-lived and continues to make lower lows. So I point that out because, again, I love to point out that these things are not always that reliable. And in this situation, again, this would just put it on the watch list for us, this kind of thing, saying this is a potential shift of energy. Put it on the watch list, then go over to your regular charts, whether you're trading whatever, a 30-minute chart, 60-minute chart, daily chart, and there you then start looking for a setup to the long side. Okay, but you don't trade off of these relative strength charts. These are just showing you that this is another energy that you can add to the first 5 and 6 if you include volume. And but again, any one of these energies, including relative strength, means very, very little. Now, let's look at another aspect of this. I'm going to actually take some of these off just because I think for teaching purposes, what's going on here? Can't remove, oh, it's data stream 1, that's why, okay. For teaching purposes, I want to just give you some more clarity here. And it's easier to see without some of these extra lines. Okay, that's good. Now, here's another way of looking at relative strength. So we've been looking at this orange one, and we've seen that, okay, now we may have a turnaround down here. We've broken this trend line, we've broken this high. But look over here at the yellow one, and this is key. This one broke this trend line here, and it broke this little high here, and it broke that high here. So point is, the trend line break occurred here much earlier than this one. Okay, so this is another way. We're looking at the hard right edge of the screen over here, but you know, at some point we would have, this would have been the hard right edge of the screen. And the point is that you don't want to just look at the worst market all the time, because sometimes these really bad undervalued markets can remain undervalued and lousy for long period of time. And if all you do is wait for the worst market to turn around and turn into, you know, a raging bull market, well, you know, it's good to watch for that, but you might be sitting by the sideline for 3 years for that to happen. Seriously. So another thing we want to do is look at now which, and this is something I do all the time, which of these markets, even if it's not the weakest, starts developing a relative strength before the others. This is kind of at the heart of the relative strength issue. All right, again, let's just clean up our charts here a little bit. So this one does a lot better, you know, than this one down here, for example. Okay, this one, if you notice, let's go back way over here. All of these were above, this is another key issue, above zero. Look at your zero line. All of these are above zero here, okay, for the first whatever, couple weeks. And then 1, 2, 3 of them all tank below zero. This one goes down, but holds the zero line. And this one ends up remaining a bullish market. Whereas all 3 of these remain bearish markets. In other words, they're all below zero. They're producing negative returns. Anything below zero is obviously returning a negative return from day one as compared to day one. Whereas this market produced a positive, and it's the only one. So this is a great example of how you would want to be in this Forex pair and not this, this, or this. Okay, it goes up and then produces kind of a sideways pattern here, and then it comes crashing down. Well, look, it breaks these lows, breaks this low here, then breaks that low. This market is continuing in a downtrend. This one actually tries at this time to break up. This one does not. This one stays in a channel and actually breaks down a little later than this one. So the only one of these 4 around this time we would be interested in is this one right here. And we might actually say, you know what, I might try to take a long there. And it would be short-lived, and you would be then stopped out. But still, based on this energy alone, and again, we never trade based on only, you know, this energy or any one energy, but this would be the market we would be looking for an entry on our regular charts, not the rest, unless you're looking to go short, of course. All right, so that's how we do it. Let's see, we've still got a couple minutes here. Let's add a couple more. Actually, let's take these off. What was that? That was, oh, yeah, US dollar, Swiss franc. So US dollar, of course, has been, had been very bullish during that time. So we'll take that off. We'll take that one off. And we'll take that one off. Okay, let's add some different ones on here. Just get a little practice at this. So euro, British pound. Look at that one. Wow. See, these Forex markets can be very, very different. Now, is it any secret, which of these two markets you want to be in? Again, your zero line is kind of your baseline. That's your reference point. And, I mean, that's just no contest. This one went up over 20%. This one went down over 15%. That's a big difference. I mean, a big part of trading is just getting into the right market. If you're in this market, back from here, making these highs, breaking these highs, this is not going to be hard to make money. But if you're trying to buy this market, this is not going to be an easy game. This is not going to make you happy down here. This one will make you happy. Of course, we're talking about longs. This one will make you a sad trader. So this is what I say is this principle is so powerful in the sense that, think back in, late 1990s with the tech bull run. I mean, my gosh, pretty much all you had to do was be buying NASDAQ stocks, tech stocks. And, there were a lot of people who thought they were geniuses. They weren't geniuses. They just happened to be in a great bull market. And so it was easy to make money at that time for those people. Of course, then the market crashed and they realized they were not traders. And so they lost all their money. Well, the best thing to do is to become a trader, become educated, become skillful, develop the discipline, and have a good trading plan that is sustainable and flexible and robust, and then combine all of that by finding a great market. There's always a raging bull market, always a raging bear market somewhere. And so find that and then use all of your talent, skill, and knowledge to trade that market. That's the best of both worlds. And it's just so much easier and it's more forgiving when you do make mistakes. And, that's what you want to do. Okay, so again, here's a good example of, here with this green one. What is this? This is, Aussie dollar. We've got a trend line break, kind of going sideways here, and finally we break up here. And these markets kind of do the same thing though, don't they? Trend line here, and these all start to break up. Okay, now this one started from a higher position, so it gets above zero. But you could have bought, really, any of these. Now this one, this purple one, did not follow through. This purple one, they all started kind of in the same direction. But then the purple one falls back down, actually made a lower low there. Right? And the green one is the one that has still produced higher highs and has not broken that low yet, whereas these have started falling down. So you never know which ones are going to continue to follow through long term. And so part of what you might want to do is to diversify. Watch for these. Put part of your money into one, part of your money into another, part of your money into a third, fourth, fifth, depending on how much money you have. In other words, diversify a little bit. And the ones that turn back against you and stop you out, hit your trailing stops, great. You let the market take you out of them. But the ones that continue to run and run and run and run, well, then you're still in those. There's no way to forecast what's going to happen in the future. Nobody has tomorrow's newspaper. So forget about that. The way you catch these big moves, frankly, is through your money management, and that's through diversification and sticking with your trailing stops on those that don't follow through. That's the way it's done. And when your money comes out of these that don't follow through, well, you've got your money in cash and you're waiting for the next opportunity to come back in another market. And the ones that run, you just keep your money in those. And it's just a continually evolving process. So that's how we do it with the Forex market, and it works. It's a way of catching the big moves and really making some potentially huge returns.